Hey folks, I want to explain to you why I have recently started buying JP Morgan stock. Now, I wish I was buying it after the earnings release because I'm now down 4% on those shares. And in my transparency, I'm going to show you that exact position. But many of you know when it comes to stability and dividends, dividend growth, and making that juicy passive income, I've been a huge proponent to the Canadian financial sector, whether we're talking Royal Bank, Toronto Dominion, Bank of Nova Scotia, Canadian Imperial Bank. I decided that I wanted a little bit more sector diversification, and I had some room to grow that sector part of my portfolio. And I'm like, you know what? Why not buy one of the largest top 10 US companies by market cap that has been growing its dividend in an insane rate and has been outperforming basically all the other banks. So that's how I came to this conclusion at this current discounted rate, because I do think it's trading at somewhat of a discount depending on how you see the market moving forward. But we're going to discuss all of this. We're going to dive down to the good, the bad, the ugly when it comes to that earnings release. We're going to be diving down into the inflation, where they see some of the risks moving forward. And if that is a conversation you can appreciate, in return, I simply ask that you hit that like button, folks, because if you've been listening to the media and this conversation is what you've been paying attention to, you probably heard something along these lines.
You do have some good news and bad news. The good news being that trading is better than expected, both in fixed income and in equities. The bad news is that provisions for loan losses are a little higher than expected. And as loans are growing, you see them growing at a slightly slower clip than in the fourth quarter, at 5% growth in average loans. That compares to 6% last quarter.
And then if you decided to actually go into the news releases from CNBC or wherever else, you're going to read stuff like this. JP Morgan Chase reports 524 million hit from market dislocation caused by Russian sanctions. I was listening to some of the earnings and I heard that they actually got hit on the halting that happened with the nickel price that skyrocketed. It had some kind of weird short squeeze. I don't know exactly what their commodity loan exposure looks like, but they do mention it in the earnings filings. But we're going to come back to this, deep dive into it in a second. Let's just talk about the stock first and foremost here, guys, because I started paying attention to this when I kind of got onto this fixed idea of I want the most foundational dividend stocks to get me over $1,000 a month. I want 12,000 in annual dividends. And I've been looking at things like Home Depot, which is trading on a dip, McDonald's, a lot of the Canadian companies like Canadian Apartment Properties, and JP Morgan made that list because it's down 25% from its all-time high, guys. It's trading down past its post-pandemic level with a starting yield of over 3% and a reasonable PE ratio if you believe there's still growth for this company ahead. And comparing it to the other US conglomerated banks, Bank of America is now down 20%, nowhere near close to its 2008 highs before the market crashed. Wells Fargo, you might recall Wells Fargo was in a scandal where they were like commissioning their employees to force savings accounts on customers. Like they were literally hiding the fact they were opening up multiple savings accounts to collect commissions, and that's what just drove the stock into the ground. That was a good buying opportunity. I traded Wells Fargo around a little bit. It still hasn't gone back to all-time highs, but at least we're out of that scandal phase. But nonetheless, guys, this is why JP Morgan has been the best performing bank, and it's the largest bank. So I figured, I'm going to pick the best of the best, and I think this is where it's going to sit. And on top of that, as I mentioned, the dividend growth, muy bien. This is the most beautiful aspect of this stock. If we go back 5 years ago, guys, the dividend was 50 cents a share, whereas today it is trading over $1. In 5 years, they have doubled the dividend. There's not many companies that can say that. Like not even McDonald's can say that. And also there's not many companies that can say they're doing this on a payout ratio that's under 25%. So if you're talking about stability in that income, look no farther. I think you're sitting in a good place with JP Morgan. Now, let's just talk about some of the other facets that they're offering here, because they are doing like a $30 billion in share buybacks. They've been doing this year over year. And we can honestly see, guys, that they have been taking the ordinary shares that have been floating around off the table, which is increasing my ownership in the company. Another really good metric to always pay attention to here, guys. Now, from a growth aspect of things, because this bank is so big and has so much exposure in different aspects of the market, their earnings have been a little bit more volatile, to say the least. In 2020, they saw some lows. They hit all-time highs in 2021. And in the recent quarters, it has been roughly downtrending. And we'll get into that very shortly here, folks. But first, here is the position. I picked up 77 shares, and it doesn't show me my average cost on this at the moment. But if I scroll my head out of the way, we can see I'm down 4.7%, just under $500. But honestly, I'm praying that it goes lower. These are one of those foundational companies, guys, where I'm not really worried about the stock performance anywhere in the near term, so long as I can accumulate it into the long term and know that the company is going to be around for a very, very long time into the future. Let's hope that's the case with JP Morgan. So let's talk about these earnings and the future forecast and what we kind of see going on in the markets that would affect JP Morgan. But from the good, we'll start with the good before we get into some of the bad. Basically, the best thing that I saw here, guys, was that the average deposit for just the average consumer depositing money into the JP Morgan is now sitting at a whopping $2.5 trillion. Jesus, man, people are really looking to save capital, I guess, and they're banking it away with JP Morgan up 13% year over year and 2% quarter over quarter. Their loans averaged 1.1 trillion, up 5% year over year and up 1% quarter over quarter. So the financial industry is booming and trucking along. So where did they get hit? Well, I don't want to break down all of the numbers here just because I don't want to bore you guys, but just in briefing, we can see that the net revenue from Q1 of 2021 is down. They obviously increased the provision for credit losses a little bit higher. I mean, we're seeing, obviously, there's some concerns there with non-interest expenses and net revenue managed. But nonetheless, guys, take a look, because for this time around, we did $2.63 in diluted earnings compared to Q1 of 2021, where it was $4.50. So that is a massive, massive dip here, right? So there's just one aspect of these earnings I want you to just pay attention here, because the provision for credit loss was 1.5 billion, reflecting a net reserve build of 902 million, driven by increasing the probability of downside risks due to high inflation and the war in Ukraine. You kind of got to ask yourself, how bad do you think inflation is going to be moving forward? Because this is what's going to hinder every person individually. This is what's going to hinder their savings, their investing, and all those aspects of their business. And I honestly think if we've survived to this point and you guys are doing okay, I think this is going to be the peak for inflation. And it's really intriguing to see where inflation's actually hitting the hardest, because it's no surprise that it's all based around energy, guys. Most of the inflation rate has been driven by gasoline, used vehicles, travel with hotel rooms, rental cars, transportation. For some reason, furniture, household energy, and new vehicles. So this is all related to vehicles and energy and travel. So if that finally peaked, which for the first time we're really starting to see used car values go down, we're starting to see the housing market cool down a little bit here in the next coming month. We're starting to see the signs of it. And considering everything on the lower end has also been kind of slowing down, I wouldn't be surprised if we see rents start to go up a little higher here. But other than that, if you look at the commodities themselves, whether we're talking oil, a lot of these things like copper, a lot of them have, from what I can tell, peaked. They're not really pushing all-time highs like lumber. A lot of them have been cooling off, pulling back. And I think that's because they're starting to sort out the problems with the geopolitical commodity supply chain, right? If that's been the largest impact we're going to see from this, then it should all technically be downhill from here from an inflation standpoint. Fingers crossed, nobody knows. I've been terrified of inflation. I think it's been a huge problem, but you can't help but recognize that if you pay attention to those commodity prices, that things are starting to cool off, and there should be no other event to lead them higher. So fingers crossed, guys. I think JP Morgan for the first two quarters to the first 3 quarters of this year where we're going to see the biggest hit. But the fact that they're still collecting a huge amount of money and savings rates are going through the roof here, guys, they should be boding pretty well for the fact that interest rates are going to go up. That interest raising environment should help protect them into the future. And as the economy stabilizes, that will really well capitalize them. So I'm still very bullish here, and I'm excited to see what the other bank earnings look like that have different kind of exposures. And it's always important to pay attention to, right? Like in Canada, the Canadian Imperial Bank is largely hindered, or basically largely derived into the mortgage market, whereas Bank of Montreal is largely comprised and has some big loan exposure to the oil market, which in the March 2020 crash, when they got hit, they took the biggest hit because oil went negative, right? So it's good to have they're like Pokemon cards. Just collect them all, because there'll be periods where one is doing better than the others, and it's just nice to have that good little mix, rather than, for me, I don't like owning them in an ETF. But I want to pass that question off to you at this point. What do you guys think about JP Morgan earnings? I'd love to hear about it, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.